Welcome to REITs Reiterated. REITs were created when US President Eisenhower signed into law the REITs Act title contained in the cigar excise tax extension of 1960. In 2002, the first REIT was listed in Singapore, CapitaLand Mall Trust. REITs provide access to invest in real estate fractionally for the man on the streets, like you and me. This comes with benefits such as liquidity, tax advantages, diversification, and accessibility, without the need for individuals to manage properties. Let's break down how 3 local factors can influence your REIT investment decisions. Before we go there, let's talk about distributions per unit. Investors buy REITs for distributions. It's like dividends for stocks. Rental income minus property expenses, finance expenses, and fees results in distributable income. Distributable income divided by number of units equals DPU. Now back to 3 factors: interest rates, inflation, and government policies.
Interest rates affect REITs in 3 main ways. The first is its unit price through something called the yield spread, which is the difference between the REIT's DPU yield and the risk-free rate. Risk-free rate is usually the yield on the 10-year bond.
So, in order to determine whether this yield is good enough for the investors for the risk they are taking, investors have to benchmark this against any stable yield instruments in the market. There are various types of yield instruments like fixed deposits, T-bills, etc. etc. But what we generally peg it as a standard risk-free rate or a fixed instrument is the Singapore government bond yields. This is the most safest and the risk-free asset. We call it as a risk-free rate. And the additional yield a REIT offers in the government bond yield is considered as the yield spread. So if you look at Singapore market, the Singapore government bond yield is about 3.3%. So REIT sector on average is about 6.5%. So you are getting a yield spread of about 3.2%. When you compare it with global markets like US, UK, Australia, this is much higher spread. The markets are spreading at 100 basis point or less, 1% or less other compared to global markets. So it's still attractive.
Secondly, interest rates affect interest expense, total interest cost of the REIT, and that affects your DPU.
There are 2-3 ways to manage the financing cost. One is to spread out your debt maturity. If you have 1 billion of debt, and if you have all this 1 billion of debt coming in 1 or 2 years, suppose your debt is coming up in this year and next year and you are moving from a 0 to 1% to 3 to 4%, your finance expenses will shot up. This will have a very severe impact in DPU. But if you spread out this borrowing cost over a period of 5-6 years, you can in a way mitigate the impact to the bottom line for the REITs. REITs also put in different kinds of hedges in place. Some are fixed rate loans, some are interest rate swaps which are used to hedge their loans so that even if the interest rates moves up, that can help protect some of the financing cost.
And finally, but not exclusively, interest rates affect capital values through the capitalization rate and the discount rate.
I think there's 2 parts of it. What are the key components that interest rate affects? The first one is obviously down to the bottom line, the DPU distributions. Higher interest costs definitely means that the less distributions per unit for your shareholders. That's one. At ESR Logos, we've highlighted back in the end of 2022 when the focus on interest rate increases was purely down to DPU. We actually had a discussion within our board and to some of the closer investors. We think that high interest rate environment, if for a long period of time it is too fast and too high, just not only impacts DPU, there's implications on property valuations. Property valuations is based on primarily 2 principles: discount rates and capitalization rates, or cap rate in short. Now, if the interest rate environment is high, that means the required returns for investors to buy or invest in real estate is higher. Higher discount rates means that for the same cash flow, you have a lower valuation on the discounted cash flow basis. Now, on the same avenue, a higher capitalization rates, which is the required returns, means that the cap rates for valuing properties will also go up, which again brings down valuation. So a rising interest rate environment has a double whammy impact when it rises too fast, too unexpected, and too aggressively on both distributions per unit, which impacts your share price, and as well as property valuations, which impacts net asset value. So for our cost of debt itself, if you look at 2022, it was about 3.63%. By the end of 2023, it was 3.91%. So estimated the increase is only 30 basis points, which is about 10% increase of our debt costs. And I think that is important because we ensured that at least the rising interest rate environment does not really hit our bottom line too greatly, because 81% of our hedges are fixed and that we refinance all the loans in 2023 early. In fact, for 2024, we did the same thing by refinancing our expiring loans in 2024 in January itself with a sustainability-linked loan.
So there you have it, interest rates affecting your DPU, operations, and net asset value. Next, we want to talk about inflation. Inflation and interest rates are intrinsically linked. They're two sides of the same coin. However, both impact REITs in nuanced ways.
Real estate as an asset class is typically considered one of the inflation hedge, mainly because your rent starts to go up in high inflation environment, be it industrial building, office building. Landlords starts to raise the rents in order to cover some of their expenses and operating expenses, etc. A point to note is that not all asset classes are same act as a very good inflation hedge. There are differences, and these differences arise because of the way the leases are structured and the cash flows the assets produce. One of the sector that tends to do well on a high inflation rate is hospitality sector. Hospitality sectors, the room rates are very dynamic. If the market rates or if the costs go up, if the landlord knows that the inflation is there, the people's ability to spend more is a bit more, right? So you can see that the room rates has gone up quite a fair bit. If you have been to Singapore, or if you've been to any hotels across in Europe or US, etc., you would have known that the hotel room rates cost much higher than what used to be in the past.
Let's take a random number of $10. It was the utility cost per room night. Now, if utility rates went up 50%, it meant it went from $10 to $15. So with hotel guests staying 1 or 2 or 3 nights, and hotel guests are less price sensitive, so it means the extra $5 can actually be passed on. We're able to also pass on rising labor costs as well. Now, the other more sort of secular trend that we feel is going on is there's a growing middle class. It means the travel demand will increase, it will improve, and the hospitality segment overall globally will continue to grow.
So hospitality sector is considered as a better inflation hedge because of the dynamic nature of the sector. The other things which can be done about leases is that if there are inflation-pegged leases, so for example, in markets like US, even Europe, what happens is that on an annual basis, the rent gets escalated based on the inflation. So depending upon how your portfolio is, generally the interest cost tends to go up much faster than the income line or the top line. So what happens is that your underlying income from the asset comes down during a higher inflation for a shorter period of time. The other critical factor how inflation impacts the asset value is by cap rates. Capitalization rates is basically the yield an investor demands for an asset to be purchased and to be held over a period of time. So in order to give an example, if you're buying a commercial property in the US, in the past, the cap rates for the commercial property in the US used to be about 5% to 6% kind of range. So investors were comfortable with buying an office building in US for about 5-6% kind of yield, right? So if the income that is coming from the building is about 10 million, and if you employ a cap rate of about 5%, the asset value would be about 200 million or so for that building based on the cap rate methodology. As interest rates and as the risks moves up, the investor's requirement of yield is much higher. This can be because of two different factors. One, inflation has moved up, the interest rates has moved up, so they can demand higher cap rates. Like the risk involved in holding that particular asset class has increased severely, and that can also result in the cap rates moving up. So what the investors are basically saying is that if I am ready to buy an asset for about 5% yield in the past when the interest rates were close to 0-1%, when the interest rates has moved up to 4% or 5%, I need 8% or 9% yield from this asset in order to buy this asset. So what happens is that if you employ a higher cap rate with a similar income from that asset, the asset value starts declining much faster. So that is why you see that the asset values are much sensitive towards cap rate movements, and cap rates inherently are much sensitive towards interest rate movements.
I think the key part for inflation, the first thing, is that the direct immediate impact that you see is actually on OPEX, or operating costs. When inflation goes up, cost of material, cost of labor goes up. How does it impact the REIT? The direct impact is actually on operating expenses. The second one that impact is on maintenance. We always do capital expenditure to make sure that the building is kept well. For example, we may refurbish the toilet in our industrial building, we may refurbish the corridors, we change the lighting. These are what we call maintenance capex. Inflation impacts the costs. The third part, the inflation have a direct impact is on the returns that when you do asset enhancement initiatives. Construction materials, labor costs becomes more expensive. So it means that it reduces the returns, assuming rentals do not follow as high. Now we come to the second part of rental. What does inflation impacts? Now eventually, this increase in costs will have to pass to the consumer.
These are inflationary times. We asked how Adrian is managing it for ESR Logos REITs.
So I guess if you look at where the top line is in terms of gross revenue, I think rental reversions in 2022 was 11.8%. 2023 last year was 11.1%. So we are still able to ensure that our rental reversions are strong and is still in the positive territory.
The third factor we want to explore is government policies, the regulatory environment, taxation, land use and development policies, urban development, and market stability measures.
Changes in regulations relating to property ownership, leasing, taxation, and corporate governance can directly impact REITs' operations and profitability. For instance, the shortening of industrial land tenure from 60 years to 30 years affects industrial REITs. Singapore's industrial land policy implies that investors would require higher yields for these shorter-term tenures, which means they need to have sufficient rent to compensate for the shorter leases. Separately, when URA allows for bonus GFA under certain conditions, REITs properties could benefit. For instance, Far East Hospitality Trust's Central Square had an uplift from the URA's SDI program. Singapore offers tax incentives to REITs to encourage their growth and to attract investors. REITs in Singapore are exempt from corporate income tax if they distribute at least 90% of their taxable income to unit holders. Additionally, certain foreign-sourced income of Singapore-listed REITs may also be tax-exempt, subject to conditions. Unit holders also do not need to pay tax on distributions from their REITs holdings. Government policies relating to land use planning, zoning, regulations, and development guidelines can influence the supply of properties available for investment by REITs. Changes in these policies may impact the availability, cost, and potential returns of properties in the REIT portfolio. Government initiatives to develop infrastructure, enhance connectivity, and promote urban renewal can create investment opportunities for REITs in sectors such as commercial real estate, including retail, hospitality, and logistics. During periods of market volatility or economic uncertainty, the government may implement measures to stabilize the real estate market. For example, cooling measures aimed at curbing property speculation and preventing asset bubbles could impact property prices and rental yields, thereby affecting REITs' performance.
The first year of COVID-19, that is 2020, was a challenging time for everyone, for families as well as businesses. Along with a number of other measures, the government introduced a package of measures to help SME tenants, whereby qualifying tenants were granted rental waivers and rent deferrals. The government provided an equivalent of approximately 2 months of rent for qualifying commercial properties and approximately 1 month of rent for industrial and office properties, and asked REIT managers to do the same. So all in all, qualified tenants would not have to pay rents for up to 4 months, depending on the kind of property they had tenanted. While these measures were the right thing to do to help SMEs, they had some unintended consequences for REITs. Rental income is the predominant source of distributable income for REITs to investors. So with these rental waivers and deferrals, REITs would not have sufficient cash flows to distribute to investors. As investors invest in REITs, mainly for their regular stable distributions, a decline in REIT distributions would have hit REIT investors hard. As the industry association representing the Singapore-listed REITs, REITAS reached out to government authorities and explained the consequences of these measures on distributions paid by REITs. Ultimately, we explained that it was REIT investors who would suffer due to lower distributions. And the government quickly understood the problem, and we had several brainstorming sessions with the authorities to figure out what could be done to help REITs and REIT investors. And then in April 2020, MAS, Ministry of Finance and IRAS, they announced a set of measures that significantly contributed to providing stability and enhancing liquidity in the sector, which benefited both REITs and REIT investors. So firstly, IRAS extended the deadline for REITs to distribute their taxable income from 3 months to 12 months after their financial year end. REITs hold very little cash in their balance sheet because they distribute the bulk of the income they earn to unit holders to avail of the tax transparency benefit. So the new measure from IRAS meant that REITs could now retain more cash in their balance sheet without suffering tax consequences. This was immensely helpful because with a reduction in rental income due to the rental waivers and deferrals, REITs needed to retain more cash than usual in order to make interest payments on their existing loans and for general operating expenses. The other measure was the government announced that they would increase the aggregate leverage limit from 45% to 50%. And MAS also deferred up to 1st Jan 2022 the application of a minimum interest coverage ratio requirement of 2.5 times for REITs to avail of this higher 50% gearing limit. So why was this helpful? Increasing the leverage limit to 50% provided REIT managers with the flexibility to access bank funding, as most bank loans are tied to MAS's regulatory limit on gearing. Without this increase, some REITs could have faced a cash crunch, which would have significantly impacted investors. And in a separate announcement, SGX RegCo also announced some relaxation measures. They enhanced the share issue limit for main board issuers to seek a general mandate for an issue of pro rata shares and convertible securities of up to 100% of its share capital versus 50% previously. In essence, what it means is that it made it easier for listed companies, including REITs, to raise money through equity. So to summarize, these measures help the S-REITs stay afloat by providing continued access to various funding channels, from bank borrowings to bond issuances and equity raises. And without these measures, the industry would have experienced a more severe downturn and taken longer to recover. These measures were incredibly helpful to keep the S-REIT industry afloat during this very difficult period. And while REIT investors did suffer due to lower distributions at the height of the pandemic, this was short-lived as distribution levels started returning to normal after 12 to 18 months.
So today we've covered some of the local factors that can impact your REITs investments. These are definitely not exhaustive, but I hope we've given you a sense of the closer to home factors to note. That's it for today's REITs Reiterated. See you in the next one.